Hello, my name is James Banks. This is an ADTA 5940 Advanced Data Analytics capstone presentation for the spring 2022 session of the University of North Texas. Today, I'll be talking about utilizing time series analysis to identify virtual currency trends based on momentum, sentiment, and economic indicators. In this presentation, we're going to be covering the following topics in sequence. We first need to talk a little bit about what cryptocurrencies are. I'm going to use the term digital, virtual, and cryptocurrencies all synonymously. The key aspect of digital currency is that it is decentralized. Basically, there is no central financial institution or country that has oversight for the currency. The validation and recording of the transactions occurs through a distributed network of nodes as opposed to a central facility. Instead of a central ledger at a financial institution, the transactions are recorded on what's called a blockchain. The process of validating the transactions on the blockchain is called mining. There are a couple of different methods to do this, and we'll talk a little bit more about that when we get into the individual currencies. Another aspect of digital currency is that they typically have no real asset backing them. This is very different from traditional currencies, which have the support of a country behind them, or stocks with corporate assets to back them. There are a variety of viewpoints related to the utility of cryptocurrencies. The proponents of cryptocurrencies often talk about how because they are decentralized, they are free from regulations. They can be used as payment in lieu of traditional currency, and that they are hedges against inflation. Naysayers argue that their variability makes them unsuitable for payment of goods or as a hedge against inflation, that their anonymity makes them suitable for illegal activities, and that the energy demands of mining make them environmentally unfriendly. Regardless of opinions, they appear to be gaining popularity. As of February 11th, there were over 17,000 different variety of coins with a total market capitalization of over $1.9 trillion. This analysis isn't meant to address or argue either side, but to look at their potential for long-term or short-term financial opportunities. Based on this plot of growth of $10,000 for Bitcoin and an S&P 500 index from 2018 through 2021, you can see two types of movement. The S&P 500 in green shows a systematic growth trend that is almost linear. This type of pattern would be beneficial to a long-term or buy and hold type investor. However, the sharp drops and rises and variability of the Bitcoin line in orange might provide more potential revenue for the short-term day trading type. So as you'll see, we have two research questions to consider, predicting for long-term investment and short-term trading. For this analysis, there were 5 coins somewhat arbitrarily chosen. The first 2 were chosen because of their size. Bitcoin and Ethereum combined comprise 60% of the digital currency market. Cardano was chosen because it uses a more economically friendly mining operation called proof of stake, compared to the more intensive proof of work approach used by the other coins. The fourth coin, Monero, was chosen because it's purported to be untraceable, and so it could potentially be used for more nefarious purposes. And then the final coin was Dogecoin. It's a meme coin which has become popular due to influencers or promoters. Again, this is a very small set, 5 out of over 17,000, so it's not the best representation, but it seemed like a manageable number to work with for the analysis. In addition to the coins, I also included one stock index representing the top 500 companies in the S&P to use as a control or a comparison. There were 3 components or sources of data that were aggregated together, and all are publicly available databases included in the references, just in case you're interested. The first was the historical price data or market data. The source for this data was Yahoo Finance, with structured data that included close price as well as the open, high, low, and volume for each day and each symbol. So in total, there were 16,152 observations. On the right, you can see a sample of what a subset of that data looked like. There were 836 missing weekends or holidays for the S&P 500 index due to the market being closed. Those were forward filled. And there were a little over 4,500 observations missing that represented time periods before a particular coin was being traded. Those were zero filled to reflect no activity. The second type of data represented economic indicators. The source for this information was the U.S. Federal Reserve or the FRED database. It was also structured data, and while there were numerous indicators available, I selected a small subset containing a seasonal and non-seasonal consumer price index, the U.S. Treasury average daily market yield for 10-year, 1-year, and 3-month instruments, and also unemployment rate. There was no real missing data. However, some indicators are only produced monthly, so those were forward filled from the first to the end of the month. The third source, and the most interesting and challenging, was sentiment data. The raw data was downloaded from the Reddit social media discussion platform called Cryptocurrency News and Discussion, with 4.5 million users. This data was a mix of structured and unstructured, with the key variable for my purposes being the unstructured body or text of each post. A programmatic search for posts referencing the selected coin names, nicknames, or symbols was downloaded with almost 3 million records. I then used the Vadar Sentiment Analyzer to categorize the sentiment or tone in each post in the range of -1 for negative sentiment to +1 for positive sentiment. Vadar is an MIT open source Python library with a focus on categorizing social media sentiment, so it was perfect for this situation. You can see an example of the process in the upper right, beginning with a sample post from January 9th. This post referenced Bitcoin with 2 highlighted comments to negative sentiment. It's over already and it's worse than you think. In the center table on the right, you can see the same post in the top line with a negative 0.949 sentiment value assigned by Vadar. So it successfully captured the negative viewpoint of the poster. And finally, then I had to get those 2.7 million posts down to a day and symbol observation, which was done by summing the mentions and averaging the sentiment for each symbol day combination. So the bottommost table shows the combined data with the January 9th line containing the post above as one of the 2,478 mentions for Bitcoin and an aggregated mean sentiment of 0.19 for a slightly positive sentiment for the day. So I ended up with 12,480 observations, which represented 2,496 days of 5 symbols. For sentiment data, I had 862 missing observations due to database gaps or collection issues that accounted for about 7% of my data. About 8 of those were 1 to 2 weeks in length, but there were 2 of them that were 1 to 2 months in length. And you can see on the right-hand graph the impact of those 2 major gaps. To address those, we did a simple interpolation technique to fill. Any missing data that occurred before the symbol was being actively traded was filled with zeros to reflect no mentions and a neutral sentiment. There are almost 2,700 missing entries for stock symbols. This was expected and occurred because we did not collect S&P 500 sentiment data. It was not in the cryptocurrencies news and sentiment Reddit, so this was addressed by filling with zeros as well. The 3 sources of data were joined based on date. There were some additional fields added for analysis, including a momentum or market direction indicator and a multiplicative return variable. Also, based on the literature review, 6 common market indicators were included, such as a 30-day simple moving average, a weighted moving average, and a relative strength indicator. Articles indicated that these would help improve model performance. So this gave me 31 features and 11,604 complete observations representing 6 symbols covering 2,692 days from October 1st, 2014 through February 11th, 2022. We did have positive or right skew for most of our variables, as you can see with the subset of histograms shown on the right. You can also see by the subset of Bitcoin box plots on the right that I had a number of outliers. This was pretty much true for all symbols. I decided to go ahead and include these observations because I was concerned that they might have some relevant information, and frankly, it was not my intent to use parametric models. I did observe some interesting trends in the economic data, the most dramatic being impact of the pandemic. You can see that in early 2020, there was a dramatic drop in yields, a drop in interest rates, and a dramatic increase in unemployment. This was somewhat concerning in that for some models, this end of the time series was being used for validation data. So these apparent anomalies had the potential to impact my model measurements. There were some important observations with regard to sentiment. There was a real concern about the aggregation approach utilized and that perhaps it mollified, softened, or muted the impact of some of the relevant sentiment. So looking at Bitcoin, for example, in the uppermost graph, volume is charted in the second graph, and the top sentiment is represented in orange, again ranging from -1 to 1, and the number of mentions are represented in green. If you look at the sentiment early in the time series, there's a wide range of positive and negative sentiment from day to day. But as I get more mentions closer to 2018 and later, you can see that my range for sentiment gets aggregated down by day to where it has less volatility. It becomes pretty much linear at that point. So there's a concern that the approach taken might have resulted in a loss of some important influencers' thoughts. You can see it in the bottom pixel or heat map graph, where orange represents negative and green represents positive sentiment. Early on, there are darker greens and brighter oranges, representing stronger sentiment. But as we continue to the right and get more volume and more mentions, and those posts are aggregated together by day, it becomes sort of a muted gray color because it's averaging out. So I'm perhaps muting some important signals. Again, this will be brought up in the conclusion section, but it is really visually represented here. It is interesting to note that as we progress into 2021, we can see that the frames start to look a little less gray, slightly more green, which implies a slightly general positivity. With regard to correlation, I used the Spearman's Rho method because one, it's more robust to outliers, and two, it wasn't as dependent on the assumptions of normality. Again, my focus was more on non-parametric models, so this seemed acceptable. Dark greens represent either a positive or negative correlation. So when you see the lighter shades or white, there is less correlation. Since these values move together, I did see a strong correlation, actually a multicollinearity, between the market price data and also some of the technical indicators. There was also a strong correlation between many of the economic indicators. Not quite as strong was the positive correlation between sentiment and mentions, but unexpectedly, there was a somewhat negative correlation between sentiment and market price, implying that as sentiment increased, market prices moved in the opposite direction. Looking at correlation between symbols, there was a strong correlation between the closing price for coins and also a very strong correlation between Bitcoin and the S&P 500. This may explain the positive performance on the models that contained all symbols, which I'll talk about shortly. As I mentioned, there were two research questions. So focusing on the first, I looked to see if digital currencies were suitable for long-term retirement investing. Our hypothesis here being that we would see a higher failure rate among a cryptocurrency portfolio than we would see with an S&P 500 index portfolio. To test this hypothesis, I started with the Monte Carlo simulation, looking to see what the probability was of a portfolio surviving 30 years for crypto compared to a portfolio comprised of stocks. As a reminder, the Monte Carlo simulation is basically based on the central limit theorem, which states that if you sample enough times or some random variable enough times, you can obtain a somewhat normalized set of values suitable for parametric decisions. So for this approach, I started with a portfolio of $1 million and invested in an equally weighted basket of cryptocurrencies made up of the 5 coins. I took a 4% annually adjusted withdrawal at the end of each year, and we did it for 30 years or until we ran out of money, meaning that the portfolio failed. This was repeated 10,000 times, and as you can see at the bottom, the histogram of the simulated expected return for the portfolio reflects a somewhat normal distribution. Of course, we did the same thing for a portfolio comprised of the S&P 500 index for comparison. The results of the simulation were not what I expected. The S&P 500 simulation resulted in a 99.5% survival rate. But surprisingly, the basket of cryptocurrencies also had over a 99% survival rate. This was contrary to what I expected based on the variability seen and the perceived risks associated with digital currencies. there was an interesting difference in that if the portfolio did fail with an S&P 500 portfolio, it usually took about 22 years. But even though the crypto basket typically survived 99% of the time, if it was going to fail, it failed very early at around 6 years. To compare these statistically, an analysis of variance on the ending portfolio values was run. In this case, the H naught was that the two means are the same, and the alternate hypothesis was that the two means were different. At an alpha of 0.05, I was unable to reject the null hypothesis, so I was unable to state that the two groups of ending portfolio values were significantly different. To continue this applied probability approach, I also ran a Markov chain Monte Carlo simulation. The Markov chain was used to help identify the long-term behavior of the various coins. Basically, a Markov chain is just a sequence of events where the probability of the event depends only on the previous event. In our situation, there are three states from yesterday. The market is down, noted by a -1. The market is the same as yesterday, noted by a 0, or the market is up, noted by a +1. The approach to this technique is basically to count the number of transitions that occur over a simulation. In other words, how many times do we move between each of these three states? You can see the counts for Bitcoin in the table in the upper right corner. And from those, we compute the conditional probability matrix given those states and transitions. These are shown in the second table. You can see a more visual representation of the states, transitions, and probabilities in the graphic to the left. For example, the probability of going from the same state to a down state is 17%, and repeating a down state multiple days in a row is 46%, and so on around the chain. This gives you a system of equations which can be solved and result in what's called the stationary distribution or the long-term behavior of the Markov chain. In this case, our stationary distribution for Bitcoin was that 46% of the time it will be going down. It almost never stayed the same 2 days in a row, and 54% of the time it will be going up from the prior day. In addition, you can multiply these stationary distributions by the means given each state, and that provides you the expected return. In the case of Bitcoin, that expected daily return was 1.003. Of course, I did that for every coin and the stock market index. As can be seen in the table, all the coins had a higher probability of going up, except for Cardano and Dogecoin. And all the coins had a higher expected daily return than the S&P 500 during the time periods analyzed. That is an important caveat to emphasize. The time period of our source data, about 5 years, is relatively short, which could definitely impact results. However, you can see based on the graphs on the right that we hit those long-term distribution patterns pretty early. After about 2,000 iterations, we see the pattern going forward representing the long-term distribution. Again, this assumes that the data used truly represents the nature of the currencies, and considering the small sample period available, that is a credible risk. So we've looked at the long-term aspects. Now we're going to move into research question number 2 and focus more on the short term for day traders. And in this case, our investigation is going to see if we can accurately predict any trading opportunities based on price, economic data, and/or sentiment. So for this question, we're going to look at building some models. First, we had to set up our new dependent variables. They were based on the 1-day lead time of our existing key variables, so we can predict tomorrow's values. As this was short or day trading, we only needed to predict 1 day in the future. So 3 1-day lead variables were created. It was tomorrow's momentum, tomorrow's return, and tomorrow's closing price. Since our data was time series based, I also built some lag variables for a variety of times. I primarily used 7-day lag to maintain a reasonable computing power. For example, just selecting only 17 key features lagged 60 days would add 1,020 new variables to each observation. So this was used sparingly. For training and validation, I used the 80-20 rule. The tools that were used were R, Python, H2O, especially the automated machine learning algorithm, Keras and Caret. As you can see, there were a number of different model types built. And of course, there were various tuning parameters for each type considered. Because of the auto machine learning capabilities in H2O, I was able to generate over 4,500 models. So looking at tomorrow's momentum, I use classification accuracy on the validation data as the metric. For our purposes, the prediction of up or down was not particularly critical, so specificity and sensitivity were not considered. You can see the top 10 models in the table to the right. The highest model achieved a 68% accuracy. It was the gradient boosting machine selected out of 172 models by the auto machine learning algorithms. It was for all symbols and it contained no lag variables. In other words, it didn't look back past today to predict tomorrow. This added some credence to the Markov chain results and assumptions. The S&P 500 index or models that contained it were typically in the top 10. In fact, there was only one crypto in the top 10 models. That was Monero at number 7. The important variables for the top model are shown on the right. Interestingly, day of the week and month were present, so clearly there was some pattern with respect to these variables, perhaps corporate earnings statements or economic announcements on certain days or months. But focusing on the research question, we saw that sentiment, return, technical indicators, and economic indicators were definitely in the top 10. The table to the right reflects the best and worst model for each symbol. In looking at the table, we again see that the models containing all symbols of the S&P 500 had a higher accuracy than single currencies. Generally, currency models were not overly accurate, although the best models for each symbol consistently beat the stationary distributions or long-term behavior calculated with the Markov chains. The long short-term memory models, which I expected would perform well due to their memory retention, typically performed worst. Again, this could be the result of the validation data selection. Remember, it was at the end of the sequence, and as noted earlier, there was some major impacts during that time. There did seem to be a pattern in that the longer time or longer lag didn't necessarily improve the model, and in fact, it typically made it worse, as can be seen with several of the symbols. It was also important to point out that for many of the individual symbols, sentiment played a more prominent role, as can be seen in the variable importance graph for the meme coin Dogecoin. In this case, sentiment from yesterday and several days before were important. This pattern would hold true for many of the coins. Looking at tomorrow's close as the dependent variable, we used R squared of the validation data because we're doing regression analysis, and in this case, the models performed very well. The highest R squared in these models was a 99% lasso for the S&P 500 index with a 7-day lag. The strong performance was pretty much across the board. You can see also that a number of cryptocurrencies were well represented in the top 10, so that was a positive. With regard to the important variables, we can see that the market data was the key contributor. The important market data in predicting tomorrow's close was principally today's close, followed by the low high as of today, and also the yesterday's low or lag 1. While initially this looked very promising, a 99% validation R squared basically means that the model was explaining 99% of the variability within the data. It seemed a little too good to be true. In plotting the predicted versus actuals for Bitcoin in the top graph, we see a really close alignment. But if you look at the residuals, you can see that there's a pretty wide range, especially if you're a day trader. The graph at the bottom of non-standardized residuals predicted against values shows that they can range between a plus or minus $4,000 and even get as high as a plus or minus $8,000 a couple of times. So again, even though the model metrics looked very positive, it still would appear to be a pretty high degree of risk using the model for day trading. A drill down from several years to a few months in 2019 really helps to visualize the issue between actual and predicted. Generally, the predictions occurred a little too late to be used by the day traders. You can see that the orange line of predictions reacts after the green line of actuals. It would have been more advantageous, of course, to see it the other way around. So in summary, there just didn't appear to be much evidence to argue that cryptocurrencies were different than the S&P 500 portfolios. We were unable to reject the null hypothesis. In fact, our survival rates were 99% over a 30-year period for both. Using the data available, tomorrow's return could not be predicted with any level of accuracy. And due to time, we didn't cover it in this presentation, but the R-squares were extremely low. Tomorrow's momentum, best case, had a 68% accuracy, and the average was 57% for digital currency only, and the average stationary distribution was 52%. Sentiment played a role, as did technical and economic indicators. Tomorrow's close looked really promising. It had the strongest set of models, and the prior day's close played the strongest role, but there was no evidence that sentiment, economic, or technical indicators played a role. And also, there was some serious concerns with the residuals and predictive accuracy. So in conclusion, to answer the two research questions, even though it's certainly higher risk, based on the data available, it did not appear that cryptocurrencies needed to be avoided for long-term retirement portfolios. While this was contrary to what I expected, they didn't have a higher failure rate than the traditional diversified stock portfolio. But on the other hand, predicting for short-term trading was not very positive. While there was some evidence that sentiment, technical, and economic indicators were useful in predictions, the accuracy for tomorrow's predictions weren't as strong as they appeared. So the results were inconclusive. Even though the results were ambiguous, there is an opportunity for additional research. One area would be to reduce the bias by introducing some failed coins if available from alternate sources. Unintentionally, a selection bias was introduced in that no failed coins were selected. Upon review, a research of potential failed coins indicated that history had been removed or their symbols had been repurposed for newly minted coins within the source data. A second opportunity for research should be to include some alternate or additional sources for sentiment. Again, we only looked at Reddit, and there are a number of other social media platforms that we could pull in to expand the sentiment data for a broader view. Linked with that would be to consider a different approach for identifying influencer sentiment as opposed to just averaging all the sentiment for the day, which again, as we talked about, could have resulted in a potential loss of some important signals as the number of posts increased. And finally, it would be important to consider some alternate investment strategies as opposed to just the buy and hold or the single trading strategies that we talked about in our analysis. In addition, there's an opportunity to attempt a number of more advanced techniques, such as vector autoregression and autoregressive conditional heteroscedasticity. These were referenced by other researchers as potential techniques for modeling. Obviously, there are a variety of approaches in the research, which is probably why there were so many articles and theories on cryptocurrency. With the sheer number of currencies being minted and digital currencies becoming more mainstream and accepted, even while creating this presentation, CNN Business reported that Fidelity Investments, one of the largest retirement plan providers in the US, would now allow cryptocurrency investments within the 401k plans that they manage. So it doesn't look like interest in this topic is going to diminish anytime soon, and there are certainly additional options worth researching further for those interested in digital currencies. The following are some key references related to this presentation. If you have any questions, feel free to reach out to me at jamesbanks@my.unt.edu. I'd like to thank you very much for your time and good luck in your future endeavors.